Sorry. Hello everyone. I hope you're doing good mentally and physically fit and fine. Just a minute, guys. Hello everyone. I hope you're doing good mentally and physically fit and fine. So, guys, in the last lecture, we are already through with lot of MCQs. We completed MCQs from RTP, from MTP, from chapter number 1, and now we are going to go from chapter number 2 till end. In this particular video, we are going to finish off all of them. Okay, guys, just a minute. Okay, let's start. So let's go to the case, and the first case is considering description of disproportionate rise in inventory quantities, which of the following is not likely to be an appropriate response to outlined assessed risk of material misstatement due to fraud? So what they're saying that there is a steep increase, there is a big increase Okay, thank you, Sakshi. Thanks a lot. I hope you're enjoying all our lectures. Do watch all of them. The concept revision, the Param question bank videos 350 plus, and the MCQ, both part 1 and part 2. And we'll be giving a lot of more things, the last day plan and everything. So I'm going to be with you. Okay, guys, let's see. So, we were discussing MCQs, and now this one. So what they are saying is that inventory quantity has increased drastically. It has increased drastically, and they think that, of course, whenever there's a big change in any financial item, there's a risk of material misstatement, and they feel that it's a fraud risk. So there's a fraud risk in inventory. There's a fraud risk in inventory. So if we go to the case, so they say that the company has many locations where substantial inventories are stored and lying. There are many locations, okay, where there is a substantial inventory. It is there and it has increased big time, and they feel that there's something fishy about it. Someone is manipulating things. They feel it's a fraud risk. So now it's a fraud risk, and the question they ask is, which is not going to be a likely, not likely to be appropriate response. So first they are saying, first response can be, guys, first response can be observing inventory count all locations, covering all the location at the same time. So they feel it's a fraud risk. So they said, let's cover everything at the same time. This can be one of the response. Okay, so that's so good. covering all the location at the same time, getting a lot of evidences. That is superb. Then B, they are saying that they are going to go to certain location. Even that is fine. You go to location where there is substantial inventory. But then prior intimation, we'll keep them informed, we'll tell them, okay, listen, we are coming, get prepared, keep everything ready, and then we are going to go. So if you know that there are chances of fraud, people are doing it intentionally, people are involved, surprise checking would have been better. Okay, so whenever there is a high risk, fraud risk, surprise checking is going to be a good response. But then they are saying prior intimation, so that is something fishy, that may not be appropriate. Then point C, more rigorous examination of packed items. If they are packed items, watch them carefully, weigh them carefully, ensure you can open few of the packed up items and see whether the inventory is really proper in there or not. Then instead of selecting some another date, end of the period reporting. That's great. So A, C and D looks very good responses, covering everything is a good response, opening boxes is a good response, more rigorous is a good response, sticking to 31st of March, good evening Jai Mahakal. Now 31st March is a good idea, but then pre-informing is not a good idea, so the answer is B. So answer is B in this case, guys. Now they are talking about revenue recognition. They are talking about revenue recognition. It has been concluded by the auditor there is no risk of material misstatement due to fraud in revenue recognition. Which of the following is the most appropriate? Now let me tell you guys what Asset 240 says. Asset 240 gives a presumption. Asset 240 gives a presumption that you should always presume. You should always presume that there is a fraud, risk involved in revenue recognition. That fraud can happen in revenue recognition. It is one of the most sensitive things. And owners keep on trying to increase the revenue. Always presume there is a fraud risk. If you have valid reasons like a single business, very simple business, okay, no complications at all, then in that case, we may go against the presumption of fraud risk and say that there is no risk of material misstatement due to fraud. And in that case, we document the reason why we are rebuting, cancelling, going against the presumption of fraud risk in revenue recognition. That we need to document that reason. Okay. So they're asking what is the most appropriate. So if you are going against the standard presumption, should you document this? Of course, you should document what are the reasons, what are the situation, why you are going against the presumption that there is a fraud risk in revenue recognition. That definitely needs to be documented. That looks very good. Then B point says that separate documentation in this respect is not needed. Separate documentation is not needed. You have to document when you are not following a presumption. Document that no risk of material misstatement due to fraud relating to revenue recognition was identified. Document that no risk of material misstatement due to fraud. We don't need to document that there is no fraud risk. We need to document why we are going against the presumption. So even that is wrong. Give reference to discussion amongst engagement team that there is no risk. We don't need to document that there is no risk of material misstatement revenue recognition. We need to give reason why we are going against the presumption. So answer is A. A is a correct answer. A is bang on target. Okay. Now guys, let's see. Next is, which of the following statement most appropriately describe responsibility of the auditor in relation to compliance with state pollution control legislation and regulation? Okay, so state pollution control law is applicable. State pollution control law is applicable. And if we don't do that, it may lead to fines and even sealing of plant. lot of things can happen. Okay, a lot of things can happen. Now we know that we have SA 250. We have SA 250 and it divides law in majorly two parts. Laws having direct effect. Laws having direct effect. In case of laws having direct effect, it says that we have to check compliance. We have to perform all the audit procedures and we have to check compliance whether we have to check compliance whether law is complied with or not. In other cases where there is no direct effect on financial statements, if it may have material effect, we have to check non-compliance. In direct effect, we have to check compliance, like specific industry related law, format of financial statements, affecting particular income expense. That's direct effect. We check compliance. We go and check compliance, and in other cases, we go and check non-compliance. When we have to check compliance, we perform all the procedures. When we have to check non-compliance, we only go for inquiry and we check correspondence. We check correspondence between the entity and the external legal authorities. Okay. Now, so the question is, sufficient appropriate evidence needs to be obtained by the auditor to verify compliance. So this is a state pollution control legislation. This law may have a material effect. This law may have a material effect on the financial statement. We have to go and check non-compliance. It falls in other laws. We have to go and check non-compliance and we have to only inquiry and we have to check correspondence between the company and the authority. So they are saying sufficient appropriate evidence needs to obtain by the auditor to verify compliance. This is other laws. This is other laws. If it is other laws, we are not supposed to check compliance. We have to check non-compliance. Physical verification of workability. Non-compliance, we have to do only two things: inquiry and reviewing the correspondence between company and the authority and the regulatory authority. So this looks proper. Physical verification and all is not required. So answer is C. Okay. Third question, answer is C. Then the auditor has observed non-compliance of law prohibiting employment of child labor, which is the most appropriate course of action for him to proceed in this matter. So they have come across, if you come across non-compliance, identified non-compliance or suspected non-compliance, okay, the most important thing is we have to think what is going to be the impact on the business, on going concern, and what is going to be impact on financial statements. We have to think about the impact on financial statement. Okay. So what we are supposed to do? He should obtain further information to evaluate possible effect on financial statements. Yeah, that looks absolutely fine. We have to see what's going to be impact on the business, what's going to be impact on the financial statements. Okay, we have to collect, we have to understand the situation, circumstances, understand the law, see the impact. Okay, what's going to be impact on financial statements. Then talk to management. Try to understand things. If it's not possible, we talk to lawyers and so on. So we'll go for further information, possible effect on finance. That's a correct step of action. Report the matter to government department. We directly don't go to government department. We have to go and understand the law, whether there is any law which says that we are supposed to report non-compliance. If there is a law which says this, we have to follow it. We don't have to do it voluntarily. We don't do it voluntarily. We have to follow the law. Whatever is expected from law, we do it. He should obtain further information to evaluate the possible effect of financial statement. He should obtain further information to evaluate the possible effect on financial statement. Beside, he should evaluate implication of non-compliance for he should evaluate the implication of non-compliance of audit risk assessment. So they are saying that he should obtain further information to evaluate possible effect on financial statement, and he should. So, and it is there written audit risk assessment, it is auditor's risk assessment. They are saying, okay, fine. If you come across non-compliance, go and see what's going to be impact, and then sit back and also think whether you're expecting it, whether you were expecting it or it's a sudden surprise, and do you need to change the risk the risk of material misstatement, assessed risk of material misstatement, whether risk assessment needs to be, this is a new information which we are not aware, it's a surprise altogether. Are there more such cases? So it affects the risk assessment, and risk may be increased. If it's a surprise, risk may be adjusted, it may be increased. So if you see A and C is having an additional thing that take the impact on your own risk assessment. That is not audit risk assessment, auditor's risk assessment. That's the copy paste thing didn't work exactly as it was required. He should express modified. You don't simply go and modify. So when you talk about this, we say that the option C is comparatively better, and we should select that. Which of the following statement is the most appropriate about documentation of non-compliance? Guys, this is going to be the English session, and we are going to have the English session tomorrow 8 a.m. Okay. So I'm trying to do justice to the South students also and justice to the North students also. Okay. Which of the following statement is the most appropriate about documentation of non-compliance with law, rules and regulation? What are we supposed to document? Only identified non-compliance or suspected non-compliance, or both, or we are supposed to document what court finally determined by the court needs, if what court says. You should always see, have you ever heard something like that we are supposed to document things what court says? It is nothing like that. So that is definitely a wrong answer. Option A talks about documentation of identified non-compliance, B talks about suspected non-compliance, and D talks about both. So answer is both. We are supposed to document suspected non-compliance as well as identified non-compliance. Okay. So guys, very simple, pretty simple. I will try to finish up things in least possible time so as to save your time ultimately. Okay. See, we are sticking to the MCQs only. We are not taking any other doubts right now. So in exam also I will say that no need to apply NOCLAR and other things till they are there in the MCQ. Alright guys, let's go to chapter number 3. So we are moving to chapter number 3, the compliance with independence requirement. The compliance with independence requirements and verification of integrity of promoters. The compliance with independence requirement and verification of integrity of promoters and key management personnel. The compliance with independence requirement has been ensured by C. Anuthi. In these regards, which of the following statement likely to be complete statement? What is going to be complete? So she is checking independence of independence, whether she is going to can remain independent. She is checking integrity. So basically what she is doing, she is performing acceptance and continuance. What she is doing is she is going for acceptance and continuance. Okay, acceptance, and she's going for acceptance and continuance procedure. Now acceptance and continuance procedure, okay, this should be done. This point is covered in SQC1. This is covered in SQC1. This is covered in SA 220, and it is a part of PEA, preliminary engagement activity. So it is covered in SA 300. Okay, that's what they're asking, in which particular essay this is covered. So this covered in Code of Ethics? No. This covered in essay 210? No. It is covered in 220? Yes. Preliminary engagement activity? Yes. Essay 300? Yes. That seems right. Such activities are required. Again, Code of Ethics 210? No. So they are saying this acceptance and continuance procedure. Acceptance and continuance procedure, it is covered in which particular essay? So guys, they have come up with a lot of interesting MCQs, and it will be great if some of them come as it is in exams. The auditor has obtained risk management policy of the company. Has obtained risk management policy of the company. Which of the following statement is the most appropriate in this regard? Okay. Risk management policy. Now, if you obtain risk management policy of the company, what will happen? So we go and as per SA 315. So we have SA 315. Okay. Sir, what are you doing? Why are you going in detail? So that you understand quickly. So, if you go to SA 315, we talk about components of internal control system, and one of the component is entities risk assessment system, risk assessment procedure, risk assessment, internal risk assessment procedure, risk assessment system or risk assessment procedure. We can say risk assessment system. Okay, and so when you want to understand entities risk assessment system, so we go and check policy. Looking at policy, entities risk assessment system policy, we understand the level of work they have done. Okay, whether they have identified and assessed risk in all different departments, all geographical areas, all critical assets, everything. So we understand the risk assessment system. We understand positives and negatives in the risk assessment system. We understand positives and negatives. Yeah. And if it's positive, then one of the component of internal control system is positive. It makes whole internal control stronger. So it's a very interesting thing to read that policy. Okay. And with the help of this, we can also identify risk of material misstatement, on which basis we go for audit. So we can also find out our own risk. We can find out risk of material misstatement by reading those policies, risk management policy. So understanding company's risk management policy is required by auditor. It may help the auditor in identifying risk of material misstatement that management failed. It helps auditor in identifying that management failed in identifying. So weaknesses. With the help of this, we may understand the weaknesses. Okay, is it about the weaknesses? We understand what are the weaknesses, problems. Yeah, that's partially true. Then second point, they say that it's not required. We should not read the risk management policy. That's definitely wrong. Audit risk is not influence, or B point is done, then C point. It cannot help auditor. Wrong. It helps auditor. The understanding of company risk management is sufficient for an auditor to develop an audit plan. It is one of the things. Okay, risk management policy is one of the thing. That's not the only thing we consider or read. Okay, so plan cannot be made on that. So best answer amongst this is it helps auditor in understanding how good is the risk management system of the company, what are the lacunas, problems and issues, and we may find out our own risk of material misstatement also. Okay, so it may help the auditor in understanding risk man. That's completely fine. So answer is A. Answer is A. We get a lot of insights because of company's risk management policy about their weaknesses, our challenges and so on. Now, next is, which of the following is not likely to be procedure for auditor to understand the company? Is not likely to be a procedure to understand the company. So if you want to understand the company, you have to collect information, obtain understanding, you need to collect loads of information. Online search, okay, online search to identify past press reports, yeah, you will gain understanding. Likely, it's a very good source of reviewing any new SEBI stock exchange requirements. As per new requirements, company will have to change its compliance and plan additional things. It's going to be useful. Reviewing whether fresh money were raised from the public issue. That's again a good source of information. Very good for understanding. Seeking confirmation letters from bankers regarding outstanding balances. See, collecting information to obtain understanding of the business and its environment, including internal control system. Okay. Internal control system, that is risk assessment procedure, collecting information, and we are understanding. But then here in the last point, we are simply performing our audit procedure. We cannot say that it's not likely, which of the following not likely for to understand. It is not for understanding, it is for evaluating, checking a financial item. It is for checking financial item. So D is more of checking rather than collecting information. Considering auditor's intention to identify significant audit risk pertaining to inventory valuation, where the following statement is likely to be true. Auditor's intention to identify significant audit risks. See guys, whenever they talk about audit risk word, don't take it to the heart. Oh, it is audit risk, audit. It doesn't mean. Many times audit risk simply, whenever you get the word audit risk, simply think it's a risk. Simply think it's a risk that things may go wrong, nothing else. Okay. Simple meaning is significant, something may go wrong. Now, considering auditor's intention to identify significant audit risk pertaining to inventory valuation, which of the following is likely to be true? If there's significant audit risk, more information. So they're saying this part of overall audit plan. So identifying and assessing significant audit risk. It's a part of overall audit plan. It's part of strategy. It's part of test of controls, test of details. Okay. Now identifying significant audit risk. So if we are going for risk, and which is a big risk, okay. See, in audit strategy, we make broad guidelines. In audit strategy, we make broad guidelines, and after making broad guidelines, okay, after making broad guidelines, then we go for plan. And in plan, the first point is risk assessment process. First plan is risk assessment process. Then once you get the risk, we go for further audit procedures. We go for test of control and substantive procedure and so on. So anyways, okay, when you want to make a plan, we make first plan for risk assessment, if required further audit procedure, after incorporate, and then if other audit procedure. So deciding whether there is a risk or not, it's a part of the plan, not a strategy. Part of the plan, not strategy. And the correct word should have been only audit plan instead of overall audit plan. We know that in traditional theory, overall audit strategy is equal to overall audit plan. traditional theory. Okay, and audit program and audit program is equal to audit plan. Audit program is equal to audit plan. Okay, just keep that in mind, that there is a difference in traditional terminology and as per SA 300. In relation to maturity levels for financial statement as a whole, which of the following statement is most appropriate? Maturity has to be decided by auditor after identification and assessment of risk of material misstatement. Maturity has to be decided by auditor prior to identification of assessed risk of material misstatement. Yeah, that's true. First comes risk levels, and then we go for the risk assessment. Maturity has to be decided by the auditor after performing risk assessment procedure. Maturity has to be decided by the auditor at time of designing test of controls and substantive procedure. Now listen, which of the following is most appropriate? Most appropriate. Maturity has to be decided after identifying assessment of risk management. No. First comes maturity, then we go for risk assessment. Maturity has to be decided by the auditor prior to identification and assessment of risk of material misstatement. Prior to all of them. Okay. Prior to identifying and assessment of risk of material misstatement. That looks fine. After performing risk assessment, that's wrong. Has to be decided by the auditor at the time of designing. No, it should be decided first, earlier only, prior. Answer should be, it should be decided prior. First you find out the maturity level, then only you can get risk of material misstatement. Guys, just a minute, we need to take break of 5 minutes. It's important. Please bear with me. And I hope you're loving it, enjoying it. We will finish up for sure in this session. We'll finish up things. Okay guys, we are back. Let's see. Chapter number 4. Chapter number 4, the first question is the revenue from operation of company has increased 40%. Revenue has increased by 40% in year 2022-23 as compared to last year. As compared to last year, revenue has increased by 40%. There are no addition in plant capacity. There are no additions in plant capacity. Which of the following statement is most appropriate in this regard? See guys, I will say that be careful. Don't interpret the word audit risk verbatim as it is. Don't interpret it like that. Interpret it with respect to context. So they are using the word audit risk. They are using the audit risk that suddenly revenue has increased. In which area there will, what kind of risk is there? Don't verbatim use the interpret it. Just focus on the word risk. If it has increased drastically, there is a risk that the revenue is overstated. Yeah. If it has increased, how come revenue is not overstated? That fresh customers of the company do not make payment. Do not make payment. Okay. So they are saying that there is a drastic increase and new customers may not make payment. Now, when we talk about risk, we want exactly risk of material misstatement here. Risk of material misstatement, that in which item things may, in which financial item things may go wrong. So A is more specific, that revenue is overstated, it is pumped up, revenue may go wrong. Okay. Here they talk about a business risk. That new customers may not make the payment. They are explaining business risk, but they are not connecting it to any. We know that it is connected to debtors, overutilizing the plant. What is this leading to rapid overutilizing the plant? It is also kind of maybe businesses, and because of this plant will become obsolete. So perfect answer, proper answer is that yes, when we talk about risk of material misstatement, yes, there's a risk of material misstatement in revenue. If there's a drastic increase, there are chances that revenue is overstated. A is the answer. A is the answer, guys. So other two are simply business risks, what may happen, operational risk, but they're not exactly saying which financial item may go wrong. So better answer is A than C and D. Now, next is the operating expenses of financial year 22-23 are same. Revenue has increased drastically. Revenue has increased drastically 25,000 to 35,000. 25,000, 35,000, but the operating expenses remain same. So what do you think? What may go wrong? Revenue is increasing, operating expense is not increasing. There is a risk that operating expense is understated. Operating expense figures of 2 years can be same. There is no audit risk. There is audit risk. How come operating expense is not increasing? There is audit risk. In second also they are saying no audit risk. So even that is wrong. Previous year figures need to be revised. Previous year figures need to be revised. Or D, previous year figures have been presented in place of current year in draft financial statements. They are not saying anything that there is something wrong with the previous year. They have not given anything like that. Then they are saying that there is a risk that by mistake, previous year figures, by mistake, they have put in the current year. There is no change. That means they are saying there is a risk that previous year operating expenses by mistake they are put into operating expense of the current year. So this can be a mistake. Of course, this can be a mistake. Answer is D. Yes, if there is no change, there is a possibility that it's a mere repetition of the previous year. Okay, by mistake we repeated the previous year and we have ignored the current year thing. Okay, so D is a proper answer. Then we talk about trade receivable turnovers increased from 1.44 month to 2 months. Now trade receivable turnovers, that is sales divided by average debtor. Sales divided by average debtor. It is in number of times. Trade receivable turnover ratio is number of times 2, 3, 4, 5 and so on. That what is the turnover ratio? But then they are talking about 1.44 months to 2 months. That means, guys, they are talking about average collection period. Yeah, it is not properly drafted. They are talking about average collection period, or they are talking about credit period. Credit period has increased from 1.44 months to 2 months. Earlier, okay, so credit period has increased. Credit period has increased from 1.44 months, to 2 months, guys. Okay, so that's an increase. So credit period increased 1.44 months to 2 months in a year. Identify the most appropriate statement. Identify the most appropriate statement. Okay, so first of all, as I said, they have not drafted properly. See, turnover is increasing. And the collection period is increasing. We are getting late payments. What is it indicating? And further, they have said that it is because of online sales. In online sales, collection is fast. It's an immediate collection. So ideally, credit period should have been reducing. So in direct distribution through online platform, there's a new online platform they have introduced. Okay, the estimate to be high in online platform. Sale happens quickly, recovery happens quickly. This credit period was supposed to go down. Credit period was supposed to go down. Okay. So they are saying it is supposed to be high. Supposed to be high. So that's wrong. In online platform, trade receivable should have fallen. Yeah. Should have been fallen. Should have decreased. But ideally it is increasing. No audit risk involved, wrong. Should have been fallen. It is possible some of the dealers may not be meeting the commitment of past contract. Therefore, the audit is that trade receivable could be undervalued. Okay. So yes, the collection period should have reduced and it's not happening. In fact, it's increasing. So it is unusual. It is unusual. It is definitely unusual, guys. If the collection period is increased, it's unusual. Therefore, there is an audit risk that trade receivable should be undervalued. Trade receivables should be undervalued. Okay. The trade receivable should be now. See, if credit period is increasing, debtors are increasing. So there's no risk of undervaluation. There's a risk of overvaluation. Finally, D is correct. Or ideally, credit period should have gone down. Average collection period should have gone down. It is not happening. There is a risk and chances that trade receivables are overvalued, overstated. And we may have to make provisions or we may have to write off. Make provisions or we may have to do write off, guys. Okay. So answer is D. Answer is D in this regard. Okay. So, but then this point is the pretty tricky point. I think there is some monumental mistake because they're talking about 1.441 months, that is average collection period. So this point was little tricky or it is an error. Either it is tricky or it's an error. But then such thing is happening again in inventory turnover ratio also. I think they have just made it tricky only. I think they are making it tricky. Nothing else. Okay. Because then you are champions of financial management. You know that there is a relationship between turnover ratio and collection period. They can be calculated with each other. Turnover is increasing, gross profit of companies increased by 3% in comparison to last year. Which of the following statement is most appropriate? GP ratio. Now, listen guys, GP ratio we're talking. GP ratio is sales price minus variable cost. Only because turnover is increasing, GP ratio should increase. That's not correct, not necessary. I can understand net profit increasing, GP ratio may not increase, may not. Okay. There is a risk that overstatement of cost of sale. GP ratio is increasing, that means cost is coming down. How come cost is increasing? Margin with customers may have increased. How come increase in margin can be called risk of material misstatement? Closing inventory may be undervalued, so profit reduces. Cost of sales may not be completely recorded. Now, this is not a risk of material misstatement. This is not RMM. So cost of sales may not be completely recorded. Cost of sales may not be, that can be the issue. Cost of sales may not be completely recorded. So D is the answer. D is the answer, guys, in this case. Now, inventory turnover ratio 2.88 months. Again, guys, so they are explaining they're explaining it in other terms. They are explaining it in other terms, 2.88 months in a year 2021-2022. Inventory turnover ratio has increased from 2.88 months in 21-22 to 3.42 months in 22-23. Okay. So that means it is slow moving inventory. Inventory is moving slowly. Okay. Now, revenue jump in current year may have need to raising the inventory holding levels. Therefore, there is audit risk misstatement in inventory. So they're saying because revenue has increased, for that more inventory is required. So there is audit risk. This is not some kind of risk. Raising may rise locked up funds in the inventory. There is an audit risk that it can lead to rise in cost. All these are business issues, that if there is more inventory, if the inventory is increasing, if the holding period is increasing, that means inventory is increasing, that funds will get stuck up. Funds will get stuck up and it is going to increase interest cost of the entity. Okay. So that is simply an analysis. I cannot call it as a risk. It is simply a analysis. It is simply analysis. This is not risk of material misstatement. A revenue jump in current year have lead to need of raising inventory holding levels. However, there is also a risk that some of the inventories with dealers could have become obsolete. It leads to auditors that inventory over. Yeah. Of course, exactly. Inventory is increasing. That means some inventory is getting piled up. Some inventory may get obsolete. It may get overvalued. This is bang on target. We cannot go for B and C both. It looks bang on target C, because B is just an analysis of what's going to happen. Okay. So perfect answer is C. So guys, it's good to do these MCQs, and some of the logics may get repeated. Some of the questions may get repeated. Okay. Now, let's see. So we have chapter number 5, black and white limited, full and private limited, fashion jingo limited, Mr. X, C. Anu, Mr. Chadha, and so on. Fashion Jingo Limited has not responded to Anu's request. What should be the possible? Now let's understand what is Fashion Jingo Limited. So these are various clients, not various clients, various entities. What's happening here? Let's see. The Fashion Jingo Limited is one of the customer of the company and hasn't replied to CA Anu's positive balance confirmation request. So a positive confirmation request was sent and third party is not responding. If third party is not responding, what should auditor do? Go for alternative audit procedure. Consider it as negative. If there is no response, it doesn't become negative. That's wrong. Give a qualified open directly, wrong. Visit customer and confirm the balance on the spot. Now, this is not a movie. Movie is not going on. So perfect answer is you go for alternative audit procedures. Advocate Chadda cold shoulder to Anu's request. What should be done? See, as I said, guys, you should scheme. You should not read the complete case study first. You should go and read the question. Then you look for the scheming. Chadda. Oh, this is Chadda here. Chadda here. See Anu's simultaneously 6 direct communication with company's external legal counsel, sensing the risk of material. She sees that there is a risk of material misstatement. She is trying to do direct communication with the external legal counsel. However, it ends up in a vein as external legal counsel, Mr. Chadda, refuses to comment. So external legal counsel is not responding. She is unable to obtain sufficient appropriate audit evidence in this regard through alternative audit procedures. So he's not responding, alternate audits are not working. So basically she is short of evidence. She's not having sufficient appropriate audit evidence. Not having sufficient and appropriate audit evidence. What sufficient appropriate audit evidence? Modify her audit opinion. Is it modify her audit opinion? Unqualified opinion doesn't go there. Directly going for disclaimer, it should be pervasive. Issue should be pervasive. If you want to go for disclaimer, there is no such hint. Withdraw from the engagement, modify the opinion. Modify the opinion is the most appropriate. There is no sufficient appropriate audit evidence in case of litigations. In case of litigations, and that's why modification is required. Okay, and depending on situation, it can be qualify or disclaimer as the case may be. But there is no hint that it is a pervasive matter, and we should directly go for disclaimer. What should be CA Anu's first and foremost response in the case of request made relating to balance confirmation from Woolen Private Limited? What should be CA Anu's first and foremost response? Should be CA Anu's first and foremost response. Request made relating to the balance confirmation from Woolen Private Limited. First and foremost response. Let's see what's the story of Woolen Private Limited first. Oh, look at the Woolen Private Limited. There it is. One of the vendor of the company from which the company has been purchasing wool for many years. Okay, on current basis, no single purchase has been made in last 9 months. That's quite surprising. Not a single for last 9 months. CA Anu wants to confirm the balance, request CFO for the sending confirmation request, to which refuses and is not willing. Something is wrong. Something is wrong with Woolen Private Limited. There's an issue. There's a dispute out there. Alternate audit procedures, withdraw from the engagement is not justified. Communicate with TCWG. Basically, there's a refusal to send. What should be the first and foremost? Alternate procedures, going to TCWG, all these things are there. But the first is inquiring the reason. The first and foremost, the first thing is understand. If you study SA 505, it says that first understand the reason. Why management is saying no? Is there valid reason for it? If there's a valid reason, you go for alternative audit procedure and try to get the evidence. And still you don't get evidence, you go to TCWG. Okay. So first and foremost thing, if there's a management's refusal of written of external confirmation, we want to find out the reason. Management response and seek audit evidence. The first and foremost. See, point number A and C are also valid, but the first and foremost is D. We have to select the best option, guys. We have to select the best option. Okay. Which of the following procedure will not be performed by the engagement team as audit procedure while dealing with case of Mr. X? Which of the following procedure will not be performed? Will not be performed by the engagement team as audit procedure while dealing with case of Mr. X. Mr. X, one of the fashion designers, has sold his designs to the company. One of the fashion designer has sold his design to the company, but owing to dispute, has sold his design to the company. Okay. Dispute, the contract got cancelled. Now both the parties are under litigation in local court of the law. The engagement team is guided as to procedure to be designed and performed in this matter. So a litigation is going on. If a litigation is going on, okay, will not be performed. It's a litigation, do inquiry by management, inquiry of Mr. X, minutes, legal expense. If you remember SA 501, step number 1 is you get more information about the litigations. Inquiry is one of that step. one of that step, reviewing minutes, legal expense. You cannot go and talk to the party, third party about it, with whom dispute is going on. That is not to be performed. Not to be performed. Okay. Guys, if you love our efforts, do put comments on the videos. We really like it when you put lovely comments for our efforts. Okay. Now, chapter number 6. So guys, we are going one by one. We are covering all the cases from the study material 23. First, we covered the case from RTP. Then we covered the case from MTP. Then we are covering the chapter 1, 2, 3, 4, 5. And now we are going to chapter number 6. Chapter number 6, guys. Which of the following should be appropriate? Which of the following should be appropriate date of signing new audit report? So from this, we understand there's a new audit report. New audit report, that means there's a revision. There's a new audit report. There's a new audit report. That simply means that there is a revision of audit report. There is a revision of audit report, guys. Okay. Now, there is a revision of audit report. The management amends the financial statements which are finally approved. Management amend the financial statement which are finally approved on 25th of July 2023. Management amends the financial statement which are finally approved. Okay. So point is, they're talking about the new audit report, and financial statements are revised, approved. Revised financial statements are prepared on 25th of July 2023. Once revised financial statements are made, after that only revised audit report can be signed. After that only revised audit report can be signed, guys. So it has to be after, on or after. So that is the perfect answer. On or after 25th of July 2023. 25th of July 2023. It cannot be before that. It cannot be. All other dates are before that. So those they cannot be there. They cannot be there. CA Sneha would have taken into account a lot of procedure to get knowledge of the events occurring after the balance sheet date up to the date of audit report relating to the company. Which of the following does not fall under such audit procedure as per SA 560? Does not fall under such audit procedure as per SA 560. Okay. So we are talking about SA 560, and they are saying that we perform audit procedures for subsequent events. We perform audit procedures for subsequent events. Okay. For subsequent events happening after balance sheet date till the date of signing audit report. So they are saying, which of the following is not that procedure? We understand management's procedure on how they identify adjusting events, how they study, analyze subsequent event, then identify adjusting event. Yes, we do that. We inquire of management whether any about the subsequent event. We do that. We see the minutes of the meetings of happening after balance sheet date. We do that. We get the interim financial statement. Yes, we take latest interim financial statement. Okay. But then here they are saying mandatorily. That is where things are going wrong. It cannot be mandatorily like that. It cannot be mandatorily like that, guys. Okay. Mandatorily, that interim financial statement should be there. Interim financial statement should be there. Now, that is not required. Okay. Mandatorily. So this is not This doesn't fall. So institute has drafted cases, guys. They have taken a lot of efforts. These are not definitely cakewalk, but then this is not something unachievable. They are achievable. They are definitely achievable, guys. Okay. With respect to the first audit report dated 15th of July, 15th of July 2023, which type of opinion was most likely provided by her? With respect to the first audit report, which type of first audit report they're talking about? Let's go to the first audit report. Now, the first major stock of the company got destroyed. Major stock of the company got destroyed on 27th of June, and it affected company's operations badly. A big accident has a major got destroyed in a fire. Business operation likely to be resumed at alternate place. Business is starting. There is no going concern risk. Postpone the issuance of audit report to consider the impact of such an event on financial statement of affairs of the company. She wants management to disclose the impact of this unfortunate event in financial statement for the year 2023, to which management has disinclined. They are not interested. Management has refused. See, we know that if there is a subsequent event and it is not an adjusting event, there's a major thing. If there is a major thing, if there is a major thing, then that if there is a major thing, then that major thing should be disclosed in notes to accounts. It should have been disclosed to notes to accounts. So management is not cooperating. Management, so basically here, management is not cooperating. And because management is not cooperating, okay, that disclosure is not there. Okay, so there is basically a material misstatement in notes to accounts. Material misstatement in notes to accounts. We should qualify. We should unqualified opinion, no. Disclaimer, no. EMP, no. That thing is missing. It should be qualified. So it should be a modified report. With respect to new audit report, which type of opinion is most appropriate? Now, what happened after signing? After signing the first audit report, fast track court has come up with a judgment that company will have to pay 2 crore rupees. 2 crore rupees. Now company is saying, let's reopen financial statements. We want to book about 2 crore rupees, loss of 2 crore rupees, and we'll also disclose the earlier thing. We'll rectify both the things. So basically, when the second report was signed, everything is getting rectified. If everything is getting rectified, if things are getting rectified, okay, we should go for unqualified opinion. We should definitely go for unqualified opinion, and we should put EMP, OMP. Of course, we should do that. We should put emphasize, if it is within financial, we should put EMP. We should highlight about this loss, about this litigation. We should put EMP. So D is better answer. D is a better answer as compared to B. Okay. The fire event occurring on 27th of June, in company's plan require the following action part of management. Disclosure in notes to accounts? Yes. Adjustment financial statement? No. Wait for the claim? No. Preparing financial statement afresh? No. Okay. Disclosure in notes to accounts. Okay. Disclosure was required. Now guys, CA Namit. Okay. We guys don't focus on reading the case before. The way we solve it is we focus on the question. We read question a lot. We read MCQ, we read options, we compare the options. Then we go to the case, we skim through the case, we identify that particular point, and then we read it and solve it. Okay. First, directly don't go and read things. Mr. Namit tells Manpreet about the auditor's responsibility in above case on a matter under discussion. Which of the following doesn't fall under auditor's responsibilities? Which of the following doesn't fall under auditor's responsibilities? Okay. So Namit is a chartered accountant. Manpreet is article assistant. Okay. Now they're having a discussion. They're having discussion about going concern. They're having about the going concern. About going concern. And what should be done if they're facing a downfall in the business never seen before due to newer technology. So basically in SA 570 there are 3 steps. If you identify events and condition which create significant doubt or going concern, events and condition, if you get events and condition which create significant doubt, which create significant doubt over going concern. Okay. Significant doubt. Sorry, guys. Actually, there's some error in the camera. I was looking at it. Okay. If there's significant doubt over going concern, we go to step number 2, perform additional procedures. And then we make conclusion about material uncertainty and going concern. That's how we proceed. They are saying that final conclusion going concern is appropriate, but there is a material uncertainty. Okay. Let's see. So if there are events and conditions creating significant doubt, we perform additional procedures. Obtain sufficient appropriate audit evidence. They are saying which doesn't fall. Evidence on the matter. Get more information. Yes. Conclude appropriately the management. Yes. Assume whether material uncertainty is yes. Guarantee the company's ability. No. So if there is a doubt or going concern, we want more sufficient appropriate evidence. Yes. Management, we go and we think about appropriateness. Yes. We think about material uncertainty. Yes. We go for guarantee. Guarantee the company's ability to continue as going concern based upon audit process. Do we give guarantee? No. We don't give any of the guarantee. Identify which set of audit procedures are relevant in above scenario. If there are events and conditions which create significant doubt, which of them are relevant? Okay. Requesting management to make assessment relating to management company's ability. Yes, this is additional audit procedure. We want more evidence. Yes. Evaluating management's future. Yes, we see management's plan. This comes under additional procedures. Make specific assessment of company's ability to continue as going on. Management have to do it, not auditor. Management has to do it. Management has to do it, not auditor. Analysis of cash flow. Yes, this is the additional procedure. Considering additional facts, if these documents like management's assessment and cash flow statement were prepared on a particular date, after that 3-4 months down the line, now what has happened? Yes, this part, that's what auditor do. These A means auditor has to do it. Make appropriate disclosure, that is management's responsibility. Requesting written auditor, writing paragraph addressed to stakeholders in audit reports, citing the results of the procedure other. Yes. So these things, wherever A is written, is done by auditor. 1, 2, 4, 5. Okay, 1, 2, 4, 5, 7, 8. 4, 5. 1, 2, 4, 5. 1, 2, 4, 5, 7. Guys, 1, 2, 4, 5, 7 is definitely okay. Definitely, even the 8 should have been there, but this is perfect. 2, 4, 6 is not there. So best is A. Along with 7, they could have gone for 8 also. Along with 7, they would have gone for 8 also, guys. That would have been better. 1, 2. But then they are not going for that. Okay, best amongst them is A. Namit's conclusion in above case will lead him to give which type of opinion? So they are saying that going concern is appropriate and there is a material uncertainty. Material uncertainty. Management has made appropriate disclosure about material uncertainty. We are going to have a clean report and we are going to highlight it by putting MUGC. Material uncertainty or going concern. We are going to give unmodified opinion and material uncertainty going concern. Answer is going to be 2 and 3. 2 and 3. We are going to do both the things. Consider the following. Management is under responsibility to make specific assessment of companies ability to continue. Of course, if there are events and conditions creating doubt or going concern, they have to make specific assessment, going concern assessment, whether going concern is appropriate or not. Statement 1 is correct. Management is responsible to make appropriate disclosure in connection with going concern. They have to make disclosure. Answer 2 is correct. Both are true. Both are correct. Which of the following most appropriate regarding going concern assumption? It signifies that company is reflecting net losses in its financial statement. Going concern is not about losses, it's about whether they will be able to continue for foreseeable future. It signifies company is not modernizing. It is not about modernizing. No intention of curtailing materially the scale of its operation in foreseeable future. Record at the prices they would fetch. It's not like assets should be recorded price. No. Whether they will be able to continue in future and they have written whether they will be continuing on the same level, almost same level of foreseeable future and not just cut down and come down drastically. Okay. C is the better answer. Going concern is all about whether we'll be able to continue in future and not curtail the operation and there will not be a major reduction in the future turnover. So answer is C. C is better. Others are not okay about going concern assumption. Now, let's see, guys. So, guys, we are through with chapter number 6 also. Chapter 6 also soon will cover all the cases, guys. Don't worry. We have covered a lot of cases. And once you cover this, these are literally top 100. These are literally top 100, guys. Now, so let's see. As regards description regarding revenue generated through cash sales of a company, which of the following statement is most appropriate? So there's something about cash sales. Let's go in the case. So there's a paragraph on cash sales, guys. Cash sales. In case company engaged in business of selling agriculture products, substantial part of the revenue is coming through cash. There is no proper system and internal control to verify the accuracy of revenue generated through cash sales. Therefore, the team has unable to verify such revenue generated through cash sales. There is no proper internal control systems. That means there is no proper internal control system. There are no documents. There are no systems. There are no systems. There are no documents. No systems are there. No systems are there. No documents are there. Okay. So, as we are not getting any information, we'll have to modify the opinion. We'll have to modify the opinion. Qualify opinion. Okay, that could be one. Adverse, we are not getting information. Qualify can be a choice. A disclaimer of opinion will be issued because a basis for disclaimer will be provided. A disclaimer of opinion will be issued and the basis of disclaimer change from financial statement. Okay. So they say that we'll give disclaimer. Yeah, 80%, guys. 80%. 80%. A major thing, a pervasive thing. We have to go for disclaimer. When we go for disclaimer, first line changes. When we go for disclaimer, first line changes. We write we were engaged to perform audit. We don't say that financial statements are not audited. We say we were engaged to perform audit. We cannot say we have audited because we are saying a disclaimer. So answer is C in that case. Answer is C, guys. So you are not getting evidence about 80% of the revenue. That's a big thing. That too revenue. Litigation matters of TS Limited. Which of the following is most appropriate? Litigation. Okay. So this is TS Limited. Has been dragged to the court by BS Limited for. So these are 5 different clients whose files are being read. Stealing trade secret using cyber theft and filed a claim of. So client there's a claim of 50 crores. On reviewing the audit file of TS Limited finds that the legal opinion of company's standing counsel is ambiguous. No clarity. There are precedent cases, case laws both in favor and against such issue. The financial statement of TS Limited are silent. Oh, that's a blunder. They are not writing anything about this litigation. That's a blunder. That's a blunder. We'll have to qualify. That's a material misstatement. Unmodified is not acceptable. Unmodified is not acceptable. Adverse opinion needs to be expressed by the auditor. Adverse opinion needs to be expressed by the auditor. We cannot talk about adverse as such. Qualified opinion needs to be expressed. Yeah. Qualified opinion, definitely yes. Okay. So guys, litigation content liability is not disclosed, we are going for qualification. There is no evidence that it is pervasive. If it's pervasive, we think about things like disclaimer or adverse. Now, considering description of the issue regarding non-recoverability of export receivable of 3 crores from the chain of stores, which type of opinion is appropriate? So there's a problem with non-recoverability. No chance of recovery. Debt has not been, if there is no chance of recovery, it should have been written off. There is a material misstatement. There is a material misstatement. We think about qualification. We'll have to qualify. As regard the matter of going concern, a small finance bank, which of the following is most appropriate? There is issue with small finance bank. The small finance bank, they have put the emphasis of matter paragraph. If there is a material uncertainty of going concern, okay, then you don't have to put EMP. That was the old SA5 old thing. Now you have to put material uncertainty or going concern. You have to put MUGC. You have to put MUGC, guys. Okay, you have to put MUGC. So in this case, you have to put MUGC. Is proper? No, this paragraph is not proper. You have to put MUGC. Yeah, you have to put MUGC, not EMP. So we are talking about MUGC thing. Answer is C. Recording issue of not informing team regarding inventory of finished goods lying at location taken on rent in Feb 23. Which type of opinion is appropriate to be issued in case of this client? There is a finished goods of 1 crore which is lying at a location, rented location, could not attend physical inventory counting, alternative procedure cannot be performed. So, inventory of 1 crore is at some location. This information was not told. It is told at the end, and there is no sufficient appropriate evidence about this inventory. So, what are we supposed to do? We are supposed to qualify. We are supposed to give modified opinion, qualified. And when we talk about unmodified, that's not the case. So, now the thing is that, let's see about the amount. It's 1 crore out of 8 crore. So major part of the inventory is not getting affected. Major part of the profit is also not getting affected. So we'll say that it's not pervasive. If it is pervasive, we go towards adverse and all. Disclaimer. If it's pervasive, we are not getting evidence. There is no hint of pervasive. So we'll go for qualified opinion. So in this particular case study, it was interesting. We have to make, we have to understand situation. We have to understand situation of whether, we have to understand situation whether it's whether it is pervasive or not on our own. So depending on things will change from qualified to adverse or qualified to disclaimer. So guys, let's see chapter number 8, that is 800 series. 800 series. And it is 810. They are talking about summary financial statements. They are talking about summary financial statements, guys. So the first question is, given the above extract of the abridged, that means abridged, there is summary financial statements and the description. Just a minute, guys. Which of the following is most appropriate? The auditor must presume that the criteria applied by Board of Trustees in preparation of the abridged financial statements are acceptable. Cannot presume that criteria applied by Board of Trustees as acceptable. The abridged financial statements have been prepared by Board of Trustees. The auditor cannot ordinarily accept the criteria applied by them. The duty bound to accept the criteria. Okay. So first, what do you mean by criteria? Criteria is basic principles and format. Basic principle and format which is used for preparing summary financial statements. Just like we have applicable financial reporting framework, we have the applicable criteria which is being used. And then SA 810 says that if criteria is issued by a recognized authority, okay, then we can definitely accept it. The abridged have been prepared by Board of Trustees as per SEBI regulation. These basic principles and format is given by SEBI regulation. Format is prescribed by SEBI. So are we supposed to doubt it? No, we can definitely accept the criteria. We're not supposed to doubt it. We can accept the criteria. May presume that criteria applied by Board of Trustees is acceptable. Yes, A looks appropriate. Cannot presume is wrong. Cannot presume is wrong. Cannot ordinarily accept is wrong. Duty bound to accept. Duty bound to accept. It's duty to accept always no. May attend. That looks fine. Yes, because it is issued by SEBI, we can normally accept it. We can normally accept it, guys. So that is can we normally accept it? Answer is yes, normally accept it. It is not mandatory. We may accept it. So that is better. Sometimes even authorities may go wrong. Authorities may do something abnormal and unusual. Now, so answer A is appropriate. Which of the following statement in reference to abridged financial statement is not in accordance with requirement of 810? Which of the following statement in reference to abridged financial statement is not in accordance with requirement of 810? Not in accordance with requirement of 810. Not in accordance with the requirement of 810. The notes to accounts should be disclosed that the abridged financial statements have been derived from audited financial statements. It's appropriate. It's appropriate. Fine. We have to see not. The Board of Studies has disclosed that audited financials are available in website. Yeah, you have to disclose it. From where a person can get a detailed audited financial statement. It should be stated in auditor's report that abridged have been compared with related information audited financial statement, determined with abridged financial statement, agree with the or can be recalculated from the related information audited financial statement. This is basically audit procedure. This is basically audit procedure. We are discussing, okay. It is an audit. They are saying audit procedure to be disclosed in audit report. We generally don't specify audit procedure in audit report. That looks inappropriate. It is not substitute. Reading summary is not a substitute to reading a detailed financial statement, even though that looks appropriate. This is not appropriate. Writing about the audit procedures is not, you simply write that audit of summary financial statement is done as per SA 810, that's it. No need to write the audit procedure. So that is the answer. C is the answer, guys. So it's interesting, guys. With the help of these MCQs, we can revise our whole chapter. Let's see, guys. Which of the following para is most appropriate to be included under the heading auditor responsibility in auditor's report? In auditor's responsibility in auditor report. So this auditor's report, and in that there is a section auditor's responsibility. What are we supposed to write in that auditor's responsibility? Our responsibility to express opinion as per standards of auditing, opinion as per 810, express opinion as per standards, express opinion as per SA 810, engagement to report on summary financial statement, express opinion on standard auditing adapted. Why we need to adapt? It is specifically why we adapt means to make some changes and then accept it. Why this thing is required? It is on summary financial statement. Express opinion as per SEBI regulation and standards on auditing. SEBI regulations and standard on auditing. Okay, guys. See, we have to perform this assignment as per SA 810. We have to perform this assignment as per SA 810. Okay. So, these things, this only standard is not good. Adaptation is not good. Specifying criteria. See, our procedures, our response to express procedures are not as per SEBI regulation. It's only as per 810. So B is the correct answer, guys. B is the correct answer. Now, which of the following para is the most appropriate to be included under the heading opinion in auditor's report? That it is a fair summary. It is consistent with audited financial statement. We use the word fair. So consistent goes out of the way. Okay. It is a fair summary as per SEBI regulation, generally accepted accounting principles. So A is further specifying that yes, it's a fair summary as per what? SEBI regulation, generally accepted accounting principle. It is further specifying that as per this criteria, everything is all good. Just like we say that financial statement give true and fair view as per applicable financial reporting framework. So, out of B and A is better. Which of the following is not element of audit report on average? EMP, OMP, management responsibility, key audit matter. Key audit matter cannot come. This is not, so here it is not an element. It is not an element. SS 700-701 says that key audit matter is applicable to listed entity, complete set of financial, general purpose, complete set. Key audit matter is applicable when you do audit of complete set. It is a summary. It is not a complete set of financial statement. It is a summary. So key audit matter cannot come. So that's interesting, guys. Key audit matter cannot come in audit report of summary financial statement. Rest of the things definitely come. So interesting. That was interesting, guys. So guys, we are moving to chapter number 9. I think we are through with almost 70%. We are left with remaining 30%. In respect of errors in some opening balances noticed as described in case, which of the following is most appropriate? So there's some errors in some of the opening balances. Okay. There are apparent errors in opening balances brought forward from previous year relating to some outstanding incentive received from government authorities, these have been swapped. These have been swapped with some other balances. So there is some opening balance of receivable from the government. So in opening balances, balances are swapped. Account heading has same balance of one has gone to another and other has come to this. So balance have swapped from some other balances, and there is no change, no credit transaction in such incentive accounts and have been swapped in the year. So basically opening balance is having misstatement. Such error should be straight away lead to qualification. Of course, qualification should be brought to the knowledge of the management. Yeah, it should be brought, but very important, it's a compilation of financial statements. Compilation of financial statement, guys. In compilation, we don't give any opinion. We don't give any opinion. When we are not giving opinion, we don't talk, we don't give any opinion. We don't give any opinion, and when we are not, we don't give any opinion, and when we are not talking about opinion, we don't have to think about qualification. When we don't give opinion, there is no qualification, adverse or disclaimer, nothing like that. In compilation, if something goes wrong, we directly withdraw. So qualification, if opening balance is wrong, qualification is not proper thing. Brought to the knowledge of the management, no effect on compliance of ethical, knowledge of such has no effect on compliance of ethical requirement by the firm. It's a very important issue and you should handle it properly as per standards, okay, and you should comply with the standards. No effect is not a correct thing. 510 is not applicable. See, we are talking about compilation, we are not talking about audit. It should be brought to the knowledge of the management. Yes, it should be brought. It should be brought to the knowledge of the management. It should be brought to the knowledge of management. That's the important thing, guys. It should be informed to the management. So it's a compilation. That's very interesting. It's compilation of financial statement. As regard the suggestion of one of the team members regarding verification of all revenues of the company, as regard the suggestion of one of the team members regarding verification of all revenues, verification of all revenues of the company, which of the following statement is most appropriate? Verification of all revenues. In compilation, we don't verify anything. We don't verify. We simply take the information and we compile. If prima facie something looks wrong, we tell them to rectify it. We don't go for verification. Suggestion is proper? No, it's not proper. It's not proper. Such suggestion is not proper, as verifying the accuracy or completeness of the information is not required as an engagement. Is not required as compliance with qualitative requirement. There is nothing called qualitative or anything like that. Specifically, it is not required. Answer is C. Adherence to appropriate standards of quality control. Which of the following statement is relevant? For all the assurance and related, services, this comes in related services, SQC1 is applicable. Assurance and related services, SQC1 is applicable. SA 220 is applicable? No. SA 220 is not applicable. SQC1 is applicable in this engagement. SQC1 is applicable in this engagement. Yes, it is applicable. Both are applicable? No. Both are not applicable? No. SQC1 is definitely, quality control is applicable. It is applicable to all the assurance and related assignments. Which of the following statement is most appropriate as regards omission of expenditure? As regards omission of expenditure under appropriate heads pertaining to Rourkela unit in compiled financials. Which of the following statement is most appropriate as regards omission of expenditure under appropriate head pertaining to Rourkela unit? So basically, they have come across omission. they have not properly disclosed income figures relating to setting up the unit. A new plant has been set up. Those figures are not properly disclosed. There is no proper disclosure. So there is basically a misstatement in financial statement. There is a misstatement. It can be misleading. The fundamental principle of integrity is violated. The engagement cannot be performed. It is affecting objectivity. No effect on performing, such as there is no effect on performing. A big information is missing. Saying no effect is definitely a wrong thing. Is definitely wrong thing. It's not about objectivity. It's not about being biased. It is not about being biased. It is definitely not about being biased. Okay, if you remain silent, it is about integrity. You are not being honest. So guys, if the compilers remain silent, it will be compromised with the integrity and honesty. They have to follow ethical requirements. They have to be honest. They have to they are supposed to take action, go to the management. If they don't listen, they need to withdraw. If they remain silent, it is an integrity issue. It is an integrity issue. In compilation, we don't give opinion. In compilation, we don't give opinion. Okay, we'll have to withdraw. A detailed documentation is maintained under the course of compilation engagement. A detailed documentation is maintained during the course of compilation engagement. Which of the following is most appropriate regarding the assembly of engagement file? A detailed documentation is maintained under the course of compilation, most appropriate. This is a lovely case, guys. I loved it. So compilation engagement is there, whether and the assembly of working papers. We know about assembly of working papers. Okay. Assembly of working papers. Is SQC1 applicable to compilation engagement? Answer is yes. It is applicable. It is applicable to compilation engagement. It is applicable. It is applicable to compile. It is applicable to compilation engagement. Okay. Now, so SQC1 is applicable. In SQC1, they talk about 60 days, but they talk about 60 days for the date of audit report. The 60 days, yes, in SQC1, they talk about audit documentation. Assembly should be done within 60 days date of audit report. That condition of 60 days is for audit. For audit, it is 60 days. For compilation, not specified. It will be as per firm's policy. It will be as per firm's policy. That's lovely MCQ, guys. Lovely MCQ. So, no 60, no 2020 as said by the firm. Yes. No requirement of assembly. No. You have to maintain document, that's for sure. So, guys, next question is about review report on interim financial statements. Let's see. The name of addressee is missing from the text of draft. So they have made some draft and the name of addressee is missing. To whom will you address? To stock exchange, we address to appointing authority. Who is appointing authority? Generally, audit committee makes all the recommendations. Like when we talk about auditors are appointed by shareholders and some of them are appointed by board of directors. Okay, shareholders and board of directors. Audit committee keep recommending things. So here we are talking about the reviewer. Reviewer is generally appointed by board of directors. So not appointed by stock exchange, CFOs, audit committee. So generally it is by board of directors. So report will be addressed to the board of directors. Paragraph 2, our responsibility is what? In para 2, We have reviewed the, so they are saying our responsibility is for what? Complete it. Our response is to give opinion. Opinion is given in case of audit. Reasonable assurance in case of audit. It's not compliance statement. In review, we go for conclusion. We give conclusion on financial statements. We go for conclusion. We go for conclusion in financial statements. Okay. Given the description of case study, which of the following engagement standard is most appropriate to be stated in para 3? Given the description of case study, which of the following engagement standard is most appropriate to be stated in paragraph 3? So in this case, what is up? It's a review thing. So 700, 810 is not applicable. We are doing review of interim financial statement. So 2410 is relevant. Then what about paragraph 3? They are saying a review is substantially dash, is broader than audit. Oh, no. Review is narrower than audit, not broader than audit. Broader in scope than audit? No. Narrower, yes. Less, yes. In accordance, an audit under and consequent does not enable us to obtain assurance. Does not enable us to obtain assurance. We don't obtain any assurance. We do not express an opinion. Does not enable us to obtain assurance that we would become aware of significant that might be identified in review. So the statement we make here is that we make everyone aware that it's not audit. It's not audit. We have not performed audit procedures. We have performed narrow procedures. Okay, so narrow procedures, and we may not get aware about all the issues and items which are there in financial statements that we might come to know by doing audit. So we are comparing, said that listen, we have performed less procedures and we may not know everything which we could have known by doing audit. So this thing is wrong. This thing is wrong. So they are saying that this thing is wrong. We have to say that we may not come to know everything which could have been identified in audit. This thing is right. So it is narrow in scope. We do less things, and because of that, we may not find out everything which we could have find out by doing audit. So we are cautious. We alert everyone. We alert everyone about the issues. Then how we give opinion? Nothing. The way we give opinion is in negative way. Nothing has come to our attention. Nothing has come to our attention which suggests that financial statements are not prepared as per applicable framework, and nothing has come to attention which suggests that not prepared as per Ind AS and not giving true and fair view. Okay. Nothing has come to any that things are not prepared and there is no disclosure. So the wordings, there is only one difference. Here they have said not disclosed and here they are disclosed. So we have to read and understand which is correct. What we give ultimately conclusion that nothing has come to our attention, to our knowledge, which suggests that something is wrong, something is not disclosed, something is missing, something is misleading, wrong, or something is not okay. So this statement is correct, that we have not come across any issue which suggests that something is wrong, something is not disclosed. If you read the B, nothing has come to our attention which says that everything has been disclosed, so that becomes wrong. If you want to give a clean opinion, we say that negative way, nothing has come to attention, we say that something is wrong, something is not disclosed. So answer is A. Guys, we are going to chapter number 11. whose responsibility is to list out assumptions underlying prospective financial statement. Of course, management is going to do it. Those who prepare prospective financial statements, they are going to do it. Whether professional accountant, no. Auditor, no. Management, yes. Banker, no. You prepare prospective financial information, you are supposed to put assumptions, clarify assumptions there. Which of the following statement is most appropriate regarding use of prospective financial information to be included in such a report? Is most appropriate regarding use of prospective financial information, most appropriate about use of prospective financial information, most appropriate. Okay, so are we supposed to write anything in our report about the usage, where it will be used? Are we supposed to explain people where prospective financial information will be used? Of course, yes. Intent use of projection is required. Is it going to use for valuation or merger, amalgamation or loan? To caution the regarding inappropriate projection for other purpose. So are we supposed to highlight the usage? Yes, in fact, caution that it is for valuation of shares. Don't use it for amalgamation or merger. It is discretionary to state. It is not discretionary, it is required. Not necessary. We are supposed to caution people. It's up to management. No. We have to disclose for what reason are this prospective financial information is prepared and for what purpose it is useful, and it is not useful for other purposes. What should be the language of such an unmodified assurance? Regarding underlying, what should be the language of such an unmodified assurance? What should be language of such if it's we again negative, nothing, we have not come across any information which suggests that assumptions are unreasonable. We use negative wording. So wherever we want to be cautious, we want to reduce the level of assurance, we don't use positive wordings, we use negative. In review also we use negative wordings, and here in prospective we use negative wordings, negatively worded. Negatively worded to suggest assumptions are not so it's not discretion. We negatively worded. Which of the following statement is most appropriate regarding the examination of prospective financial information by chartered accountants in accordance with SA 3400? Which of the following statement is most appropriate regarding the examination of prospective financial information by chartered accountant in accordance with SA 3400? Accuracy of projection is vouched. We never vouch for accuracy. We simply talk about the assumptions. Are they reasonable? Projection can go haywire. It depends upon professional judgment of chartered accountant to vouch the. We never vouch accuracy. We can never talk about the accuracy. We cannot assumptions. So no reporting is not a correct answer. Which of the following statement is most appropriate regarding UDIN? Regarding UDIN in context of examination of prospective financial information by chartered accountant is most with respect to UDIN. UDIN is mandatory for all the reports and certificates. It's mandatory for all the reports and certificates. It is mandatory to state UDIN in such type of reports. Yes, of course. It is desirable, not required. Not required is wrong. As we go to chapter number 12, that is digital auditing. Let's see. The first question is the reputation. They are talking about an insurance company. They are talking about insurance company where all the information should be put by on website, and they have a system where the software is going to do everything. Software is going to check the policy number, is going to check validity of the policy, it's going to check everything. They have automated the things which are generally done by human beings, repetitive nature things which are done by human beings. So that's called a robotic process automation. It's a repetition. We have seen this. Which type of attack we are referred to? They are demanding money. They are demanding money. People are demanding money. That's ransomware. Demanding money is ransomware. Okay. Now, not part of risk assessment procedure to assess cyber security risks. Not part of risk assessment procedure to assess cyber security risk. Okay. Is not, see, risk assessment procedure is collecting information, obtaining understanding so that we can find out the complicated areas, the pressure areas, the judgment areas, the issues, problems, okay, which is not part of risk assessment. And they're talking about in paragraph C. Looking to cyber risk is making inquiries. Yeah. Making inquiry regarding process and control to privileged accounts. So any accounts having special powers. Patch management. So whenever there's an updation of the systems, there's a patch. Patches are generally the upgradations which protects the system from the new risks. So getting more information of privileged accounts, patch, vendor risk management, program, all these are risk management. Also perform external network penetrating testing. Now, these all collecting information. That is risk assessment. External network penetrating testing, whether penetration can happen, it is a testing. Risk assessment procedure is about collecting information. This is not collecting information, this is testing. It is not a risk assessment procedure. And they are saying which is not a risk assessment procedure. It's a testing procedure. It is response to risk. It is what kind of services being provided by an entity described the above for example of use. What kind of services they are talking about in paragraph D. Verificatory is an entity which can stamp email for any files. It simplifies certifying of email or just emailing to them an email specifically created for each customer. Many law firms can use this service to certify documents. Information is secured by a network of thousands of computers distributed across the globe. It uses cryptographic algorithm. The information can be verified from anywhere in the world. Its hashing, the time stamping is of significant evidentiary value. Listen guys, this is blockchain technology. In blockchain technology, information is distributed over different parties, thousands of computers, okay, thousands of computers, and so if you want to keep record of anything, you can use this technology. And it stores information chronologically one by one in the form of blocks. See, if you store information at one place, it can be manipulated and no one will come to know. If you store the same information at 10 different places, and that too every change is verified and then change takes place, it is very difficult to manipulate it, because you can manipulate one location but 9 other locations are not going to change. So when you store same information at different locations and you make changes after a lot of verification, stringent process, you have set of information which is impossible to manipulate. That is blockchain technology. So they are using blockchain technology. Which of the following falls in audit described in E? Please when you do audit of an entity, the timelines are agreed in a meeting with a key management person or electronic meeting program. So on Zoom, they're talking, the entity also agrees to provide data electronically. Meetings are on Zoom, data is electronically, video conferencing will be used. It's called remote audit. It's called remote audit. The opportunity to present doctored document is decreased. In fact, doctored documents, manipulated documents, opportunity is increased. So decrease is wrong. Remote access to sensitive IT system may not be. Sometimes they may not allow access to their IT system. That is correct. So which of the following is false, they are saying? This is false. Not promote sensitive IT system, remote access not allowed. True. It provides comfort and flexibility. It provides comfort and flexibility. That is true. Time zone issues are there. True. So the issue is, the first one is the answer, false. Chapter number 13 is all about group audit, guys. Okay. So last few things, guys. Let's finish it off. Just a minute. Okay. Disclosure of additional information in consolidated financial statement. In consolidated financial statement, as stated in paragraph A, which of the following statement is correct? As per Schedule 3, you have to disclose what is percentage contribution. Percentage contribution of the whole group in net assets, percentage contribution in profits, percentage contribution in other comprehensive income. Okay. So percentage of consolidated revenue from operation is correct. It is not proper as percentage of consolidated revenue from operation along with respective amount pertaining to holding company and subsidiaries also required. No, it is not required. It is not required. So there only three things: net assets, profits, and other comprehensive income. It's not proper as percent of other comprehensive income along with respective is required. Revenue from operations, or it is disclosed now. Guys, listen, as I said, three things: net assets, profits, and other comprehensive income. The word they have used here is total comprehensive income. Total comprehensive income. So that is wrong. It should be other comprehensive income. So it is not proper because of this reason. It is not proper because of this reason. So again, it was quite they played with a single word. They literally played with the single word. Okay. Now, what should be auditor's proper course of action pursuant to the following situation highlighted in paragraph 3 for foreign subsidiary. So there's a foreign subsidiary and there's a gap. Ours is 31st of March and their ending is 31st of December. So, and it is so they're talking about division 2. That means Ind AS is applicable. As per Ind AS, 3 months of gap is allowed. 3 months of gap is allowed. The auditor should insist on drawing of financial statement to 31st March. No, redraw, no need to make financial again. Can accept management's version. What is management's version? It is not practicable to draw. Yeah, management's version is correct. However, so this is better. For his 3 months, if any significant transaction event has happened, the effect should be given. This is better answer. C is better. Which of the following is correct in respect of goodwill and other matters described in case scenario? Which of the following statement is correct in respect of goodwill, and other matters described in the case scenario? In respect of goodwill and other matters described in case scenario. Okay. There's a goodwill of 50 crores and has arisen on account of acquisition of a subsidiary during the year and there is no impairment loss. So there's a goodwill of 50 crores and had arisen on account of acquisition of a subsidiary and there is no impairment loss as on balance sheet date. Beside, adjustment have been made in consolidated finance with respect to intra-group indebtedness and those into harmonization, different accounting policies. So basically, in consolidation, goodwill has occurred. That's a permanent consolidation adjustment. And intra-group indebtedness, it is done every year. That's a current consolidation adjustment. Harmonization is done every year. That is a current consolidation adjustment. So basically there is one permanent consolidation adjustment and two current consolidation adjustment. That's what they're talking about. Goodwill is a current consolidation adjustment, wrong. Everything is a current is wrong. Goodwill is permanent, correct. Rest are current, correct. Answer is C. Everything is not permanent. So one of them is a permanent, which is done generally the first year. That is permanent consolidation adjustment. And you okay. So okay, that's fine, guys. Interesting one. Most appropriate regarding consolidation of financial statement acquired on 15th of June 2022. One of the subsidiary acquired 15 June 2022 is in dilemma regarding correctness of consolidation in group financial statement. Acquired on 15th of June 2022. So consolidation is happening on 31st of March 2023. So it is acquired middle of the year. A subsidiary is acquired middle of the year. Income and expense of subsidiaries are included in consolidated financial statement from the date it gains control. Yeah, that's true. Assets and liability recognized at the acquisition date. Yeah, that's true. Complete year is wrong. Income expense are included from the date of gain control is correct. Preceding year rate is wrong. Complete year is wrong. Perfect answer is A. From the date it gains control, that is A. As regards reporting under CARO 2020 in respect of consolidated financial statement, Which of the following is in accordance with requirement of law? Reporting under CARO. It comes to consolidated financial statement audit report. We don't apply the 20 clauses, only the last clause. Clause by clause reporting is wrong. So they stand alone, and along with that all subsidiary. No, we don't make CARO report for all subsidiaries combined. It is not required. Details of subsidiary where there is an adverse remark. Yes, where there are adverse remarked. Only clause number 21 is applicable to audit report of consolidated financial statements. Only that last one is applicable, guys. Chapter 14 is about bank audit. So chapter 14 is bank audit. Let's see, guys. So as regard dormant deposit account in a branch, which of the following is not part of duty of concurrent auditor? These are dormant deposit accounts. Nothing is given about that. About dormant, what are the options? Let's read options. Verifying that dormant account are reviewed with appropriate authority. Revived, of course. Dormant account, if transaction has to happen, revival is to be done. Proper authority. People can misuse dormant account to withdraw the money. So is not part. It is a part. We should see whether revival is proper. Authorization for withdrawal. Account holders to ensure that status of accounts remain active. Verifying the dormant account branches aging more than 10 years have been transferred. Deposit Education Awareness Fund. DEF. Yes. This is not given in module but given in MCQ. That if a dormant account is outstanding aging more than 10 years, then it has to transfer Deposit Education Awareness Fund. DEF. Yes. That is correct. So be careful if your dormant account. It may get transferred. Then following up with account holder to ensure status of account remain active. Examine authorization for withdrawals. Now it's not duty of concurrent auditor to follow up. That bank will do it. Bank will do it, guys. It is responsibility of bank to do all these things. Okay. So it's not part of concurrent auditor. So that's what they're asking. This is not part of concurrent audit. This has to be done by management, following with the customers to ensure they remain active. This is management's responsibility. CASA account is current and savings account. Open our KYC compliant. Which of the following best sum up scope of KYC? What we check in KYC? Basic purpose. They have issued KYC. The basic purpose of guidelines without duplicate customers at same branch. 360-degree credit profile. It is not about credit profile. KYC is not about credit profile. It is anti-money laundering. Anti-money laundering. We don't want fake things. Direct benefit transfer, DBT. Okay. Such guidelines can detail requirement, customer acceptance, whether properly accepted, identification, monitoring. Yeah, you go for KYC, you check whether customer was proper. After explaining everything, we have accepted the person as customer, identification of customer, monitoring transaction, risk management, to see whether they are genuine customers or not. Whether they are genuine customers or not. Okay, whether they are genuine customers or not. So definitely, guys, D is a proper answer. It is not just for duplicate, and it is not for DBT, direct benefit transfer of the government. It is for identifying that okay, real people are there and real people are our customers and not fake people, fake profiles. Temporary, most appropriate. Now they're talking about that there is a temporary, as regard reporting of matters, temporary over limits in cash credit account. Temporary over limit in cash. So there is a CC account and there is a temporary increase. there is a CC account. There is a CC account and there is a temporary overdraft, temporary increase, temporary overdraft is there. Okay. Cannot be reported. Concurrent auditor cannot report this as it fall. What is written in the chief manager's power? He finds temporary over limits are granted to few borrowers availing cash credit files up to 10% of their respective sanction limit within the powers of the chief manager. Temporary overdrafts are allowed to few customers in their current account. However, granting this temporary also falls in chief manager's delegated power. Temporary over limits and overdraft, as discussed above, have been adjusted and paid before the end of the month. So limit is crossed. So point is whether concurrent auditor should include it. Cannot be reported. The said instance can be reported in monthly concurrent. No discussion is necessary with chief manager. Monthly can be reported monthly. However, discussion is necessary. Cannot be reported. See, cannot be reported is extremely wrong. How cannot be reported? It is a breach. Okay. You should include, but you should have a discussion, include properly that there was a breach, there was a limit was not followed, but within the limit. You should discuss this report with chief manager and then only you make it. Then only you make it. It should go in the concurrent audit report. Proper discussion and proper wording should be there. It's not something wrong, but it's not good also that limits are crossed. Is most appropriate of fresh advances in same industry. So what's happening is a lot of advances are given in same industry. 5 fresh advances were given as per the powers in same industry. Jute mill. He feels branch approach is not proper and sanction of 5 advances same industry lacks diversity. If you keep giving loan to same industry, there is lack of diversity and risk increases. Something goes wrong to the jute industry, a lot of loans will become NPA, need to be written off. Such a lending lacks diversity and needs to be reported without fail. Increases credit risk and needs immediate attention of higher authorities. Lending has made within chief, it does not fall in concurrent domain to question wisdom of lending decision conforming to the bank norms. Although lending has been made within manager's power, branch should have reported to higher authorities flagging sanction of fresh advances same industry. Only this aspect should be reported in concurrent auditor's report. Okay. So basically all the rules, regulations are followed. Everything is followed. Everything is followed. Only thing is that loan is given. Now there is no such policy. No such policy that loan cannot be given to one industry. Concurrent auditor is supposed to check whether policy and systems are followed. That's it. He is not supposed to question the decision making, whether policy is followed properly or not. There is no policy which prohibits that you should not give loan to one industry. Maybe it happens that they give to one industry. So it doesn't fall. Very interesting. Lacks diversity, but no need to report. No need to report. It is absolutely fine. Concurrent auditor has to see compliance of the policy, not question the decisions. If policy is complied, everything is fine. Okay. But then earlier, sir, the limit crossing is an event. It is no written policy that you cannot give loan to so and so parties in one industry domain. As regard matter of living foreclosure, if you repay loan early, foreclosure charges are imposed. Just a minute, guys. Which of the following is most appropriate regarding reporting of matter into temporary? Okay, no. Foreclosure charges, guys. Just a minute. We'll go through foreclosure charges. One of the borrower of the branch falling under the definition of small enterprise has shifted credit facility from branch to a bank in private sector. The branch has levied foreclosure charges. Disregarding the code of bank's commitment to micro small enterprises, the borrower is still having current account with the branch. Reversal of such charges will lead to revenue loss of the branch. He is in a fix as far as reporting is concerned. So basically, one loan is shifted. If you repay your loan early, there are foreclosure charges. But then in small and medium enterprises code, it is written, don't put such charges. Okay, don't put such charges. But it has disregarded the code. And foreclosure charges are imposed. The matter should be reported even though it would lead to revenue loss. See, a code is not followed. Concurrent auditor's work is pretty simple. Whether policies are followed or not, he has to report on it. If something is not followed, code is not followed, it should be reported. It should not be reported. It should be reported only for disregard of code without highlighting revenue. No, you have to highlight everything. The matter concern branch management decision. It does not fall in preview concurrent. It falls if policy is not steps, procedures, policy is not followed. It should be reported. So guys, it was an interesting case in bank. It was all about concurrent audit, issues in concurrent audit. A lot of judgment was also required. Board of Directors has passed a resolution for non-compliance of public deposit. Which of the following is the most appropriate in this regard? See, we have to make report on audit of financial statements, and we have to make a report to Board of Directors also in NBFC. This is for NBFC, guys. Is for NBFC. You have to make two reports: report to shareholders on financial statement and report to Board of Directors also. Passing a Board of Directors resolution. So, if the resolution is passed, if you recall, if reporting to board, it is divided into first reporting for all NBFCs, reporting for accepting deposit, not accepting deposits, and not required certificate of registration. So reporting is required to Board of Directors in BOD report. BOD report. Okay. The director has passed in BOD report. It is required. In CARO report, it is not required. Honestly, in CARO report, it is not required. Not required to be reported is wrong. It should be. If you have passed a resolution of not accepting deposit, it should be given in the not report to Board of Directors. It should be given report to Board of Directors, not in CARO. Reporting is required. Matters to be committed. It is to be reported in report to Board of Directors, not CARO. Then certificate of registration. The matter of certificate of registration is reported in report to Board of Directors as well as CARO, in both. In both. Only report to board is not fine. Report to board of company as well as under CARO is correct. Report to Board of Directors. Further, we also have to specify whether the company is entitled to hold such certificates. Yes, in BOD report, we have to specify extra things. Both B and D's are correct. D is having more information, so it is preferred. Regarding certificate of registration, it has to be put to report to Board of Directors also and CAR report also, both. Cash embezzlement. It's a fraud. It's a fraud. Okay. So if there's a fraud, it needs to be reported. No reporting under CARO is a wrong answer. CARO is applicable to NBFC. CARO is not applicable to bank. It is applicable to NBFC. No reporting is wrong thing. As well as no reporting in BOD, no reporting in report to board. There is no fraud reporting is required in report to board of directors. Under 143 also no such reporting is required. So such reporting is required in CARO only. That's the correct answer. In CARO only. For fraud, it has to be reported in CARO. Capital adequacy ratio in report to board of directors. It's not required in notes to accounts. It's not required. Auditor has to also verify whether such ratio disclosed in NBFC has been correctly arrived at. Yes, we have to report whether capital adequacy ratio is properly calculated and properly reported in NBC 7 and it whether fulfilled or not. Answer C is better. This is relatively B is better, covering everything. It doesn't have to be disclosed in financial statement. No. Capital adequacy ratio. The point of capital adequacy ratio needs to be given in report to board of directors. So guys, you should have knowledge on report to board of directors, what items go in report to board of directors. There are 4 headings and that there are things. Okay. So about capital adequacy ratio, yes, when NBFC not accepting deposit, if it is systematically important, all these things are required. Systematically important, all these things are required. The auditor has performed audit procedure to allowance for loan losses. Ind AS has performed procedure to allowance for loan losses. As these allowances involve significant judgment estimates, she wants to state how it is addressed by her, how she can do it. So Ind AS is applicable and they have expect credit loss model. As per Ind AS 109, they have used a model and they have determined the loss and they have provided for the loss. Expected credit loss model, they have done that. So as these allowances involve significant, lot of judgment is involved. You don't have to write in report to board of directors. There are certain items you don't have to write about how calculations were done. Report to board of directors, no. Emphasize of matter paragraph. Lot of efforts. See, it is written there. It is a significant judgment. We have discussed in key audit matter, 3 types of things go in key audit matter. Significant risk, significant judgment, significant events or transaction. It is a matter of significant judgment. Lot of efforts are put. No such disclosure is required here, guys. Key audit matter. If lot of efforts are put, if you are working on an area where significant judgment are there, lot of efforts are put in key audit matter. See, the way loss is determined, nothing to BOD report. 143 is silent about such things. EMP, nothing is written in financial statement which need to be highlighted. Nothing is written in financial statement which need to be highlighted. Okay. Now this is a PSU, guys, based on paragraph A. Where will paragraph A, CAG is doing audit of a ministry or department. If CNAG is doing audit of ministry or department, it goes to PAC, Public Accounts Committee. It goes to PAC, Public Account Committee. Conceptualization paragraph B, the above audit finding is likely to fall under which area? Non-adherence, you are not following the law. State government owned, you are not following to one-time settlement guidelines. One-time settlement guidelines are not being followed. Compliance audit. There's a non-compliance of things that is being checked. Compliance audit. Annual report of listed public company, Mini Ratna, diversified into Indian Railways. Annual report of listed company. The statutory auditor of PSU is to be conducted by a firm of auditors appointed by shareholders. No. In case of many other government company, auditor is appointed by CNAG. Conducted by CNAG. No. Auditor appointed by CNAG and given directions. Appointed by shareholders. No. In government companies, appointment is done by CNAG and directions are given by CNAG. Audit is done by CA firms. Considering the nature of audit findings, paragraph D, delay in completion of work of thermal power plant, there is a delay. That's a part of performance audit. Delay in completion, performance audit. Checking economy, efficiency, effectiveness. If it's delay, it's not effective. Direct reporting assignments. If you're simply checking financial statement, that's called attestation engagement. If you make your own reports, analyze, and then you give reports, performance audit and compliance audit are generally direct reporting engagement. They are not attestation engagement. They are not attestation engagement. Okay. So their guide price pretty interesting. So finally we come to the last case. A long session is coming to an end, but then all these MCQs are extremely important. We are coming to the last part, guys. Last thing it is now. As regard anti-corruption, anti-bribery policy and organization of awareness programs for dealers conducted, which of the following is most? Now listen, you should have knowledge of BRSR. Okay. BRSR report. Business Responsibility and Sustainability Report. BRSR report that's applicable to top 1000 companies. It's applicable. In that there are sections. In last section, there are some essential indicators and leadership. Essential indicators are mandatory, leadership are optional. So you have to comment on a lot of things in this report about what you are doing for environment, what you are doing for society, what about the governance. So you have to report about anti-corruption, bribery policy and awareness programs for dealers. Conduct accounts with the year. Which of the following is most likely to be true? Most likely to be true. Having an anti-corruption bribery policy. See, honestly, guys, it is not given in our module also. Anti-corruption policy is a very big thing. Bribery is very big thing. It should be mandatory. It's a common sense. It should be mandatory. You cannot do anything else. It's not in our module also. It is a mandatory. It should be essential. And how we dealt with our dealers, it should be optional. So essential indicators are mandatory, leadership are optional. Both essential wrong, both leadership wrong. One is essential and one is that is correct. Is opposite, that is wrong. So C is the correct answer. Anti-corruption, which is very important. It is an essential thing. Guys, this is a common sense. We cannot open websites and follow the content which is not in the module. They have done that. We can't help. You can remember these things. There are 9 principles, guys. There are 9 principles and they have asked what will go. So The 9 principles, I've made a shortcut. Is she PIO, person of Indian origin? Is. It is not EAC, ECEAC. Is she PIO? E stand for ethical principles. C stand for consumers. E stand for employees. These are principles. We cannot change the sequence. Principle 1, 2, 3. S stand for stakeholders. H stand for human rights. E stand for environment. P stand for public policy involvement. I stand for inclusive growth. O stand for your offers and information which you give to consumer. Is she PIO? That's the shortcut. Is she PIO? Is she PIO? And 9 principles are there. 9 principles are there. Now the hazardous waste, it is related to guys, environment. It is related to environment. So if you see environment, first is ethics, C is consumers, employees, environment is 6. Recycle, hazardous, e-waste, disposal of paper waste. Which of the principles are involved? See, principle 6 is involved for sure. Recycle, reuse is involved in consumer. Make good products for the consumer, make it reusable, recycling, that's covered in. See guys, pretty difficult to remember, but then I have given one shortcut to you, use that. Principle 2 and 6. So wastage thing was covered in principle 2 and 6. Maybe they may ask more question. Do remember what comes in what principle. I've given the shortcut. You can see my concept revision also. It covers in 2 and 6 both. Membership of various industries, associations so as to provide inputs to the government. Involved in policy formation. Involved in policy formation. Public policy formation. 1, 2, 3, 4, 5, 6, 7. Clause number 7. Principle 7. Inclusive growth. When we talk about inclusive growth, we talk about that everyone should develop, everyone should become, everyone should earn, everyone should grow. Inclusive growth and equitable development. CSR projects undertaken by company in designated aspirational district of country, carrying out real-time net promoter score, energy audits. Inclusive growth, you need to include everyone. CSR is a part of it, guys. Net promoter score, energy audits, it's not part of inclusive growth. Then last is what is essential indicator and what is leadership indicator. Essential indicators are mandatory and leadership indicators are voluntary. This is a perfect answer. So guys, last one was pretty interesting. You have to remember all the 9 principles. That's a very important part. Guys, I hope you loved it, enjoy it. Bye bye everyone guys. Okay. We are through with the session.